For the past decade or so, we've been in an environment where bond yields have been low and stocks have been high. Lower bond yields mean stocks go up, and these two forces were feeding on each other. However, now we're entering a different environment and the dichotomy is coming out, and there's one additional force that makes it particularly important for stocks and their future performance. We've talked about the Fed the past several videos. You can go to the past 2 videos to get our full outlook on the Fed and why we believe what we believe. Today's video, we're not going to talk too much about the Fed. We're just going to acknowledge what the Fed is doing, and they're hiking interest rates. So, in the past, we'll call it a year, the U.S. Treasury 10-year yield has gone from roughly 1% to a little over 4%. I might be a little bit rough on that initial 1% number. Don't have it offhand. It's gone up a lot. What does that mean? If you lend the U.S. government $1,000, you used to get $10 per year on top of that. Now you're getting $40 per year on top of that. If you have $1 million, you can do the math. When you get to that $1 million range, which is where the big kahunas are, let's not forget, the bond market is bigger than the stock market. That 1 to 4%, that $10, which doesn't seem like a lot, $40, which doesn't seem like a lot, becomes a big freaking deal. And these people want to buy these bonds when they are offering better yields. So, when bonds are offering better yields, they just simply become more attractive investments. It's as simple as that. You went from $10 to $40. Now you might, if you're old, you might be saying, I could have Apple, I could have JP Morgan stock, I could even have Exxon, I could collect this dividend, but I'm taking some principal risk, which I don't need to take if I can get a good return and not necessarily have to take that same principal risk with the bond. So, yields up, you might see some outflow from stock into bonds. Obviously, we've been seeing that. We've been seeing that so far this year. Hopefully, I've made that clear. You might have even known that before you came to this video. But the important thing I want to reiterate that is kind of, in my opinion, the X factor here is the other side of the equation for stocks. Not the side that, the calculation that involves the risk-free rate of return, but the side that involves earnings. Because you're going to have a double, and we are currently experiencing this, a double whammy of forces on stocks. And guess what? The Fed is saying they don't care about the equity markets. Equity markets are volatile. So don't expect the Fed to come in and save us anytime soon. What's the point here? Well, yields are offering better returns. They're going up. So stocks, no matter risk you have to take for these things, you're going to see some outflows just because the yields are going up. We all know about this force. We're seeing it. It's obviously visible in our pocketbooks. It's been visible in the other direction for the last 10 years. And voila. The other side of the equation is earnings. And earnings, they're coming down. Recession, it's looking more likely. We're not there yet. The economy has remained strong, surprisingly strong even to myself. I've been expecting a recession for some time. The economy is remaining strong. We had positive GDP. I can't say we're in a recession right now. So, when earnings come down, if interest rates stay the same, stocks come down. Because what is a stock? Well, ultimately, it's the same thing as a bond. When you have a bond, you give them $1,000, you get the $10 or you get the $40. You pay up to get a stream of cash flows every year. That $10, that $40 just coming in every year. And then at the end, you get your $1,000 back. You get your principal back, in theory. Some people do it for 6 months. Some people do it for 30 years. They'll put $1,000 down, collect $40 every year for 30 years. It's a long time. Stocks are similar in theory, maybe not in a bubble, in practice in a bubble, but in theory, stocks are similar. You put money up, you invest money into a company, that company takes that money or does its thing, I guess an IPO takes that money, and it uses that money to produce cash flow for the business AKA you, because as a shareholder, you are the business, technically, at least from a receiving cash flow perspective. However, when those earnings come down, well, do you still want to pay the same amount for them, or do you want to pay less? So, earnings coming down, rates going up, consumer credit getting squeezed, balance sheets getting squeezed, unemployment going up, less spending, lower velocity of money. These things that are happening or are forecast to happen take earnings down. So let's use the same bond example. $1,000 on the table, buy XYZ company. It makes $50 for every $1,000 per year. It did for the last 10 years. But now, they need to borrow money to produce that cash, as many companies do. Those interest rates went up. Well, it's going to cost a little bit more, so that 50 is going to go down to 45. Well, unemployment went up a little bit. So a lot of their customers had to flee. That 45 went to 42. Well, their business customers are really tightening the belt. That 42 went to 35. Now this company is in a downtrend in terms of earnings. It's likely that its stock is also in a downtrend because when you decrease the earnings, people are less likely to pay up to get those earnings, the same amount. If you can choose $50 or $35, you're going to go with the $50 if it's $1,000 to buy it. If the $1,000 drops to $700, then they're equal. You see what I'm saying here if you didn't already? Stock prices have to come down if earnings come down. And if you saw Meta, if you saw Google, if you saw Amazon, if you just saw PayPal, all of that, those huge double-digit single-day moves, all on earnings projections and guidance. What are the earnings going to come or look like before? So, we already knew rates, but now we're getting the second whammy, which is earnings. And the first whammy, based on what the Fed said yesterday that we discussed in the last two videos, is coming right back. So what's the point here? The point here is we have to be defensive. We have to be defensive. That's what I'm doing. Very unusually high levels of cash right now, over 30%. That's just what we have. We're waiting. As we said a couple other videos ago, we're waiting for the right pitch. We were waiting for the right pitch in terms of shorts. We got into the shorts somewhat. We're still even defensive on the shorts because we saw some interesting action today. We'll talk about that in a second. And there are some companies that aren't in that earnings contraction environment that don't necessarily need to borrow so much money because they already have the capital investment underway and they're in a position to pay off debt. Those are companies like BTU, paying off debt tremendously, literally gushing cash aggressively. Great company, fundamental macroeconomic tailwinds behind it to continue to propel it. Exxon, growing earnings tremendously, stock performing tremendously, dividends going up. We can own these companies. We can feel okay about them. We can own those. But the vast majority of companies aren't in that position. So you have to do your homework, find those companies. If you happen to be a high net worth or foreign individual, of course, I can do that for you. But, it's a whole process, whole risk tolerance that I don't feel comfortable, providing you answers for. Because if it goes wrong, I don't know your individual circumstances to, guide your position appropriately. So you have to become a client. You have to meet that minimum net worth requirement. It's a legal thing. If you were worth 200 grand, you gave me 200 grand, I would have no problem with it. But the government has its rules. Yeah, I have, a loose minimum capital requirement just to make it worth my time because it does require time and focus and planning and thought and distraction, et cetera, et cetera, et cetera. It's not the point of this video. Interesting price action. I think we covered the earnings and the rates, but interesting price action that I did mention. We bounced off the lows today. We did make a head and shoulders. I think that'll kind of give us that next leg. But we just need to be cautious and aware of short covering. I think that's what it was. We just saw a straight bounce right up into a nice head and shoulders. That looks like some short covering to me. It doesn't look like there's actual buyers present, especially when we have no idea where rates are going to go. I think over the next couple weeks, we're going to see Fed members come out and start talking, and that might give us some clarity into how hawkish the Fed actually is. So, nothing too crazy yet. We'll see what happens. It's a long game. We're playing the long game. We'll see what happens. That's today's video. Until next time, peace out.